You will not imagine how the second largest bank in the United States has finally come to a shocking end. It is a horrifying mystery since its inception 4 decades ago. But can you imagine that it just took a day and a half for it to fall apart? Once seen as a major tech banking player, SVB's stunning collapse has brought a headache to many rich venture capitalists and tech startup owners. So, what went wrong? How has its closure affected its clients? Make sure that you stay still till the end of this video so that you don't miss any part of this saddening plague that has befallen the most loved bank in the US. Let's first head back to the year 1983, when this bank was first opened to serve as a banking ground for tech startups. It quickly grew into popularity until nearly half of the country's venture capital-backed technology and life sciences companies like Roblox, Roku, and many others put millions into the bank, helping SVB become one of the nation's largest. After the banking crisis that triggered the Great Recession, President Barack Obama signed the Dodd-Frank Act, making banks like SVB face stricter regulations. Things didn't stay that way for long until 8 years later during the Trump administration, when some of those regulations on smaller banks were removed. 2 years later, SVB was loaded with cash as many businesses deposited more during the COVID-19 pandemic. The deposits tripled in 2 years to $189 billion, making 2021 SVB's most profitable year ever. Like many of us, the SVB's financial team got crazier with the money and therefore used that cash to buy tens of billions of dollars of longer-term US treasuries and government-backed mortgage securities, the products that are usually considered safe. In just 1 year, SVB's securities portfolio rose to about $100 billion. Things later didn't go straight as expected after SVB's interest rates rose while the bond prices fell, making many banks, including SVB, that were holding a lot of bonds sit on a bunch of losses. Soon, SVB's investments were worth $17 billion less than their fairer value. To make matters worse, as interest rates grew, new deposits shrank, falling nearly $30 billion from March to December. CEO Greg Baker told CNBC that he kinda felt that they were bottoming out to a very lower point. The vast majority of the bank's deposits were held in just 37,000 accounts that held more than $250,000, the amount that was insured by the FDIC. Then in a regulatory filing on March 8th, SVB announced that it had sold a large chunk of securities at a loss of about $1.8 billion to help it cover that decline in deposits. The regulatory filing that Wednesday sparked a lot of fear, and the stock fell a tremendous amount, which is not a good sign, and the investors were already on the edge. Later, the crypto-focused Silvergate announced that it would wind down and return all deposits, so the bottom was about to fall out, and CEOs of startups began receiving urgent calls from panicked venture capital investors. What started as a trickle of withdrawals quickly turned into a tidal wave as word spread across the valley and more startups pulled their cash out of the bank. This was the beginning of the end of SVB. The next day, the bank's stock price went into a free fall as customers tried to withdraw $42 billion in deposits. And finally, SVB ran out of cash. It was on that same day that SVB's doors were closed as regulators seized it. In a statement later, SDIC said that customers would have full access to their insurance deposits in 3 days. But the banks had more than $151 billion worth of deposits at the end of 2022 that weren't insured, which meant that most of its clients' amounts were over the $250,000 limit. Now, here is where the real problem began. At the end of last year, the bank had $175 billion in deposits, and approximately $151 billion of those deposits were uninsured, leaving only $24 billion of those insured. So, what does this mean? A lot of wealthy individuals and large companies are in greater danger of totally losing their money. This situation can be described as an extinction-level event for tech startups because thousands of them did their banking with SVB. A quite saddening situation indeed. The collapse of SVB, a key player in the tech convention capital community, leaves companies and wealthy individuals largely unsure of what will happen to their money, a thing we haven't seen in a very long time. In fact, it is being reported that this is the second biggest bank failure in the whole of US history. The closure marks the biggest bank failure since the 2008 financial crisis, and the second largest in US history after Washington Mutual collapsed during the industry-wide meltdown. This is according to FDIC data. At the end of December, Santa Clara, California-based bank, the 16th largest bank in the country, had $209 billion in assets with more than $175 billion in deposits. Just like the other FDIC member banks, SVB deposits were insured up to $250,000 per depositor. Worry is now over a run at SVB, and things are not good for those that had an overdue of the agreed $250,000 in deposits. Luckily, anyone who had less than $250,000 in the bank will be covered by the FDIC insurance. For the uninsured depositors, FDIC promised them receivership certificates for their balances. Last week, the regulator promised them that it will be paying uninsured depositors an advanced dividend within this week, with the potential additional dividend payments as the regulator sells SVB's assets. The guarantee that each one of them would get their whole money back was based on the amount of money that the regulator gets as it continues to sell SVB's assets, or if another bank takes ownership of the remaining asset. The only problem is that not each one of these uninsured depositors will have been settled in this. Just try and think of the tech community, which held much of the larger amount in SVB. Also, there are rising concerns in the tech community that until those prices unfold, some companies may have issues making payrolls. It is very unfortunate, and just like we noted before, FDIC announced that SVB had $175 billion in deposits as of December 31st. And remember, of the $175 billion in deposits, $151.5 billion of it was uninsured. Which means that the tech community might actually get exactly zero, even though a sizable number of them likely pulled their deposits in the past few days. As SVB is liquidated, hopefully those who had uninsured deposits at SVB will eventually see some of their money. But for the time being, many are facing a complete and totally different type of nightmare. Take, for example, Y Combinator. Its CEO, Gary Tan, expressed his disappointment by saying that his company is now on the brink of facing an extinction level alongside other tech startups. Please keep in mind the thousands of tech startups that had banked at SVB often as their sole bank. You can try to imagine some startup receiving $250,000. Can that last long? Probably not. The number one pressing issue for these startups is payrolls, as we had mentioned before, and you have to bear in mind the number of employees who will have a tough day with their bosses for delayed payments or no payment at all. This might look very usual, but deep down their employers, it is not a thing they would carry in their hearts all along. As we speak, there are rumors about venture debt options coming from providers like Breaks, and to be honest, this might not just be enough to avoid the massive shutdowns of almost all American startups in the next few weeks. The truth of the matter is that there is an extinction level event for startups, and it will send startups and innovation back by 10 years or more. Also, from the look at the whole situation, we can conclude that it's not just rich venture capitalists that are suffering. It's real-world businesses and their clients and employees who are feeling the direct pain of the SVB failure today. The tech community and their clients and employees, this bank collapse could soon hurt the economy, as most of the companies and businesses, which are the economic drivers, are turning to depending on loans and holding their operating cash. If nothing is done to change the growing situation, then very soon there could be more bank runs of major banks. So this brings us back to you. What do you think should be done to help the situation? Please don't forget to drop your comments in the comment section below. This marks the end of our video today. We hope you guys found it interesting and especially informative. If you loved watching, why don't you give us a thumbs up? Lastly, make sure to subscribe to this channel and hit the notification bell so that you don't miss out on any of our future videos. Thank you for watching, and let's meet in the next video.